SPMOs beating QQQ by 30% over 5 years. And it crashed way less during the rough patches, too. SPMO's downside protection shines here. Losing just 23% versus QQQ's brutal 35% crash saves your portfolio when it matters most. SPMO's crushing it with a 126% 5-year return, leading competitors by a massive 30 percentage points. QQQ's 96% 5-year return looks solid until you realize it's trailing the category leader by a significant margin. Over 3 years, QQQ's 120% nearly matches SPMO's 117%. They're practically neck and neck now. SPMO's been ahead for 5 years straight, but QQQ's catching up fast lately, like race cars where the leader's advantage is shrinking every lap. Nearly identical performance here. SPMO's 17% trails. QQQ's 18% by just 1 percentage point over 12 months. SPMO's 0.8 sharp ratio crushes QQQ's 0.5, delivering far better returns for every unit of risk you're taking. SPMO edges ahead with a 1.8 Sortino ratio, slightly better than QQQ's 1.7 at protecting your downside risk. Risk-adjusted returns work like mechanical leverage. SPMO delivers more return per unit of risk, making it a smarter, more efficient way to build wealth. SPMO's 19% volatility means smoother rides and calmer nights. QQQ's 23% delivers wilder swings and bigger heart attacks. That 4% volatility gap might seem small, but it compounds into smoother returns and fewer sleepless nights long-term. SPMO's 23% drawdown protected capital far better than QQQ's brutal 35% crash during market downturns. QQQ's 35% crash versus SPMO's 23%. It's like drowning in different depths. Both hurt, but one lets you breathe easier. QQQ bounced back faster despite crashing harder. SPMO's shallower fall still took 443 days to fully recover. SPMO's worst year, losing just 10% versus QQQ's brutal 42% drop, shows dramatically better downside protection when markets crash. SPMO's 0.13% fee beats QQQ's 0.2%. That's 54% more you're losing to costs every single year. SPMO's winning on returns with 126% over 5 years while protecting your downside better, just a 23% drop versus QQQ's brutal 35% crash. Think of expense ratios like couch change slipping away annually. QQQ loses more than SPMO, and over 20 years, that money never gets to compound. QQQ's 51% tech allocation means when the sector crashes, over half your portfolio goes down with it. SPMO's 34% tech allocation spreads your risk across sectors. You're diversified while still catching growth opportunities here. SPMO gives you 21% exposure to banks and insurance. QQQ's basically ignoring the entire financial sector at 0.28%. QQQ's betting half its pizza on tech with zero financials. SPMO spreads slices across sectors, so you're covered when one table empties out. SPMO's diversified strategy means you'll avoid those brutal crashes that can wipe out years of gains overnight. SPMO's diversified approach is like spreading eggs across multiple baskets. When tech drops, you're protected. QQQ's concentrated bet? That's all your eggs in one risky basket. SPMO's built for steady growth with less drama, while QQQ's your tech-heavy thrill ride with bigger swings. SPMO's the steady marathon runner. Consistent pacing, balanced approach. QQQ's the sprinter. Max effort, higher pain, chasing those speed records. Pick your race. Standard disclaimers here. Do your own research and consult professionals before investing in anything. If you enjoyed this deep dive, subscribe for more head-to-head battles with real numbers every week.